The 721 exchange and DSTs, how it works, when is it good, when is it not good. When a Delaware Statutory Trust investment is ready to wind down, typically they put the property up for sale and the investors do a 1031 exchange out of the DST and into their next property. Sometimes, depending on the market, depending on the type of offers the sponsor gets for the property, and typically in all the DSTs, the current DSTs being syndicated in the marketplace, there's an option to do a 721 UPREIT. And that basically means that when the property is sold to a REIT, the investors can swap their membership interest in the DST for operating units in the REIT. This is called an UPREIT, 721 UPREIT. Now, the good part is, depending on the asset class, depending on market conditions, this could be a win for the investors. Because let's say otherwise they wouldn't have gotten a good offer. There were no other good offers. The REIT offered the best option for either break even or some good appreciation. However, the downside is that once you're in the REIT, if you sell your position in the REIT, there's no other 1031 exchange available to those investors. Now, there are also DSTs being sold, syndicated in the market today, where the only option is what they call a forced UPREIT. So typically, a REIT will take a property out of their REIT, establish a DST with that property. Investors will buy into the DST. They'll receive monthly income just like other DSTs. And then after a 2-year holding period, the REIT will buy that property back into the REIT, and all the investors are forced to accept operating units in the REIT for their membership interest in the DST. This can be not a good investment strategy for a lot of the investors, depending on their age, how much runway they have. Typically in our industry, there's something called swap till you drop, and part of that strategy is to keep rolling over your investments so that when you pass, your heirs get the step up in cost basis. So if you're in your 20s or 30s or 40s and you wind up doing an UPREIT, well, is that REIT going to operate well for the next 30 years, 40 years, 50 years of your life? How many investments operate at a profit for that extent of time? Now, there's the reverse of that. If you're an older investor in your 80s or 90s, an UPREIT can be a great tool for your estate planning, because when you pass and you get the step up in cost basis, a REIT position is easier to liquidate than a DST position. So if you're working with your clients and they're looking to invest, an UPREIT, how it works, how it operates, how it integrates with DSTs is a conversation that needs to start before they make the investment. So if you like this video, hit like and subscribe and check out our other videos.